So a little while ago, I had a client came into my office and said, "Chris, I'm looking at buying this business." So, we had a little conversation. I said, "Okay, what's the business do? What's it about?" He said, "It's a tech business, great business. I'm looking at buying it." So I went up to him and said, "Okay, fine. Send me all of the details. Let me take a look at it. I'm gonna get back to you. I'll see what we can do." So I took a look over details, and in the details is all of we called them pro forma analysis, including how he was going to finance this entire transaction. So I took a look at it and I noticed, I was like, right, this is over $1 million. And he's putting very little money down. I found that very curious. Fast forward, the deal was approved. How did he do this? And how can you replicate this? In this video, I'm going to explain exactly how you can finance the purchase of a business with as little money down as possible. That way you can finally start the business of your dreams. So before I got into the financial industry, I really didn't understand exactly how finance really worked. I didn't really even understand how businesses were bought or sold. I didn't even think that that was an option. Even something as simple as buying a franchise. I used to look at that and say, how are these people coming up with $200,000 to $300,000 to $500,000 that they need in order to start their business? I would always hear about, some of the individuals coming from across the world, had no money, 2 cents to their name, and trying to figure out how they were able to turn that 2 cents, buy all these businesses, and have a huge success. Didn't make any sense to me. There was always that gap in between. They had no money, and all of a sudden they bought the business. And I was always trying to figure out, what did they do in between? What was it that they did in order to finally bridge that gap? Once I finally went into the financial industry, I unlocked the keys. I figured out exactly how they were doing this. Not only did I find out how they were doing this, I found out why their methods were the best methods available. So before we go into exactly how, I'm going to quickly explain the various methods and then why you might want to use each of the methods. So the first and most simplest method, and I'm not going to spend any time on it, is you self-fund. So you borrow from family or friends. That's one of the first methods. People might mention that. It is a method. It's probably not the one I would recommend, but it is an option. Sometimes you're forced, you have no choice, you have to do it, and you have to self-finance. That's fine. Let's put that one aside. Now the second method is you work with a bank. So you may say, why would I want to go to a bank and how do I actually do this? Well, one of the benefits of financing with the bank is you're not going to be using your own capital. You're going to get to employ what we call leverage. So let's say you had $100,000 to your name and the business costs $100,000. You could buy the business cash like I mentioned before, we put that one aside. Or you finance it. Now let's say you were able to finance 90% of it. Go to the bank gives you $90,000 and you put down $10,000. Now you still have $90,000 to your name. And you can use that $90,000 to first help you to service some of the debt if you need, but you can also use it to help you to grow that business, to bring it from its current level to the next level. That's one of the most important things as to why you would want to finance through the bank. The other reason why is, honestly, the debt, even with the higher interest rates right now, is still relatively cheap when you compare what you would need to get as a return on your own money. Typically what you would see in a regular small business, if you're looking at putting in equity, you should be getting 20-30%. Now, that's not the percentage you would normally hear when we're talking about investing in the markets. We're not. We're talking about your small business. You should be able to grow that money 20-30%. That's not unreasonable for a small business. So when they're charging 5% interest, 6%, 7% interest, it's a whole bunch cheaper than the 20 or 30% you might require on your own money. Now, let's say banks aren't available. There's alternative lenders. There are third-party lenders, non-traditional lenders is what we call them. This could be individuals who have entered the lending space. These are also companies that have entered the lending space, and they do lend to businesses. They have short-term and they have longer-term financing. It really does depend. So if you're looking at doing a deal, that is also another avenue. Now, an alternative lender will typically charge more than a bank, and that's because they're willing to take on more risk. So if they want more risk, they're gonna want more reward. Now, one of the hidden methods of financing, and it's the one that people don't really think about, but it's always available, is something that we called it a vendor take back, a VTB, or owner financing. Now you may be thinking, wait a minute. The owner will finance? Yes. You can actually get a loan from the existing business owner. You can pay them from the profits of the business. Now, pretty soon, we're going to actually get into why they would want to do that and how you can negotiate that. The benefits are just outstanding. One, you're not going through a traditional lender, so there's no hit on your credit rating. Doesn't show. The other thing that it actually does is it keeps the old owner, it keeps them having a vested interest in the business. What can happen is you buy a business from an owner, and then the owner, maybe they weren't as honest as they said. Maybe they fudged the numbers. Who knows? Or maybe they decide that they want to go and they want to steal your previous client. They're their clients, their old clients. What this actually does is it keeps them at the table. It keeps everybody honest because they're only going to get paid if the business succeeds. So if they really want that money, then that's the only way they'll get paid. And if they don't get paid, then the reason it's called a vendor take back is the vendor will take back the business, which would mean no harm, no foul to you. So it's an excellent way. And it's actually one of the ways when I had my client, is one of the things that, I was looking for. I wanted to see, was there a vendor take back? Because it helps to make sure that that deal is more likely to succeed than fail. Now, the last method is you can actually combine all of these things. You can do part bank, you can do part your own, and then you can do part vendor take back or an alternative lender. You can mix and match the financing. You really can get creative. Now, at the end of the video, I'm going to give you some tactics that the pros use to try to get their deals approved from the vendor and from the banks. So you want to stick around because I'm going to give you the insider tips that you need. So now let's take a look. What would a bank, what would a vendor, what would they be looking at? What is it that they're going to want to see to make sure that this deal is going to go through? It really boils down to just two main things. There are other things, but these two main things, they really sum everything up. First thing they want to look at the capacity. Capacity is simply, does this business generate enough money to pay for the debt? That's simply what it is. They want to ensure that the cash flows that are generated from this business cover the principal and the interest payments. If you're the previous owner, you want to make sure that, you're actually going to get your money back. This really helps to determine how likely you are to default. So let's say you buy that $100,000 business and it generates $100,000 a year in net cash flow. There's a very low likelihood that you're going to default. And because of that, it makes the deal look very good. Now, if you're in that same business and it only generates $10 a month, well, there's a high likelihood that the business cannot service the debt. So there's a high likelihood that you're going to default, and that's a deal that no one would want to do. The second thing they want to look at, security. If you do default, how do I know I'm going to get back my money? The previous owner wants to know, how do I know I'm going to get back my business? And a bank or a lender, they're going to want to know, how do I know I can get back my money? Now, it depends on the deal. That could be something like, well, there's equipment that could be sold. There's patents that are worth money. There might be real estate. There's a variety of different things that can be used. And the other thing that sometimes can be asked for, in all fairness, is a personal guarantee. And what a personal guarantee means is that you yourself will make sure that it's paid by any means necessary. That could be your personal residence, it could be your car, whatever the case may be. That's something that, a lender might ask for. So now what are some tactics that you can use to ensure that this will get approved? I want you to remember one thing. Every single thing is negotiable. You can structure the deal in a way where all parties win. So what you have to start thinking about is, what is the incentive? What does the owner actually want? So the owner, for example, if you're buying from them and they want to sell the business at $500,000 and you're saying, okay, I want to pay $400,000, I want you to finance it. They may not want to finance that business. They may say, no, I want my $500,000. So one of the things that you can do is you can say, all right, I'm going to give you what you're asking for, but I want you to give me 10 years to pay that back. Now they're getting exactly what they want and they're going to get it over time. So you can get very creative. You can structure the deal in whichever way suits all parties. It might be half bank financing, half vendor take back. Maybe you put down 5 or 10% to sweeten the deal. Now you might want to ask, well, why would a business owner even want to give me a loan? One of the reasons why is, believe it or not, selling a business is very hard. The reason why it's harder is because there's not a lot of people buying businesses. Because not a lot of people know that it's an option. Because people think it's a lot harder than it actually is. So because of that, think of it just like the real estate market. If there's a lot of sellers and very little buyers, the price comes down. With a lot of these businesses, there's just more sellers or more people willing to sell than there are willing buyers. So you can use that to your advantage, but still structure the deal in a way that benefits everyone. And remember that you can design this in the way that suits all parties. So the key is, find out what matters most. and then play to those needs. So if the dollar amount matters the most, then extend it. For some people, they actually do not want the lump sum because if they take the lump sum, it might result in a much larger tax payment than if they were to take it over time. So if you're able to even explain that to them, they might actually see the real benefits of you paying over time as opposed to just paying for everything at the same time. Now that really does depend on where you're living, the tax laws and stuff, but look at the potential advantages and try to pitch it as an advantage. And the one thing that I mentioned before that you can also do, if you really want to get the deal done and you want the previous owner to finance it, maybe even consider paying a premium. Sometimes it's worth it to pay a little bit more, get the terms that you need, and close. Because right now, if you think about it, if you're generating zero money from not owning a business, if you're able to even generate an extra $1,000 a month and all you have to do is pay a certain amount back and you put basically nothing down, that's a win-win. And if you put very little down, even 10% down, it's still going to be a win-win. So these are the greatest tips on how you can finance any business purchase. Now, if you want to learn more about how you can grow a business, you can click on this link. I hope you found this one useful. I'd love to hear from you in the comments. Please leave a comment below. Let me know if you're looking at potentially buying a business and what are the types of businesses that you're interested in. I hope you guys found this useful and we'll catch you in the next one. Peace.